So you've heard of private equity and venture capital, but sometimes are confused by what they are and how they are the same or different. I get it. One question I get asked nearly daily is private equity and venture capital the same? In this video, my promise is you'll go from beginner to expert in understanding what each is, how they are similar, and where they are different. So you sound like a genius in class, your next dinner party, or your next interview. First, let's start with what is equity? Simply put, equity is the ownership of something, typically a business. It is represented by what's called a security. Sometimes it can be bought or sold, like common stock, preferred stock, etc. So when I buy the security called common stock in a company, I own a part of that company. And as an owner of the company, I have a right to the future portion of any profits of that business. So an example of equity would be, let me take you back to when I was in high school. So when I was in high school, I was part of this thing called Junior Achievement. And at Junior Achievement, we started a company. And as part of the company, everybody had to buy stock in the company to make us owners. So stock cost $1 and I bought 2 shares because that was the maximum you could buy. And then we ran our company. And at the end of the term, we had a bunch of profits from the company. And in this company, we sold these like little wooden boxes. I still have one today. And yeah, so we would make the boxes in this course, in this program, and then we would go out and we'd sell them to our friends and family, and then that would generate profits. And at the end of the day, we took our shares and we said, hey, here's my share. And everybody that owned a share got their portion of the profits of that business. Now, I could, in theory, have sold my share to somebody else, and somebody else could have looked at it and said, hey, I want to buy that share, so then I get the future profits of the business, and I would pay, they would try and guess how much those future profits would be. And that's basically what's happening in the stock market, is people are buying and selling these shares of companies, and they're trying to guess at like how many profits they would be able to get in the future from owning that share of stock. And that's how they figure out the price of equity. Okay, so now that we understand what equity is, let's talk about private equity. Now here's the tricky thing about private equity, is that really it has 2 definitions. There is what it sounds like, private equity, equity that is private, and I'll explain what that is. But then it also can refer to this whole asset class that's very similar to venture capital. So let's first talk about the top level definition, because equity that is private actually refers to both private equity, leverage buyout, that whole side of things. And it also refers to venture capital, because in both cases, the equity that you are buying is quote unquote private. Now, what do we mean by private? What that means is that it's not public. It's not freely traded on the New York Stock Exchange. You can't buy and sell it on Robinhood. It's private. It's held by private individuals. And so it is what we call in the industry illiquid or less liquid. Now, liquid, if you think about liquid in a cup, right, it moves very freely. And that's the same concept with liquidity when it comes to stocks. If a stock has a lot of liquidity, it means it can move fairly easily between buyer and seller. You can have public stocks that are more or less liquid. So think about a big company like Airbnb or Spotify, right? Lots of people know that brand. Those brands, they want to buy and sell the stock. There's lots of buyers, lots of sellers. It's very liquid. If you go to the penny stocks, it may be a company that's less known, and there are fewer buyers and fewer sellers, and so it's less liquid. And so if you look at the price, it jumps up and down depending on how many buyers and sellers there are. Take that same concept and apply it now to private equity, where I don't have like a market that I can buy and sell, not even the penny stocks, right? There's a limited number of people I can buy and sell the stock from, and so it becomes super illiquid. Okay, so the key point though with private equity is that it's equity, it's just being traded between private individuals and not on a public exchange. Now that you know what equity is and what private equity is, let's make it really confusing and talk about private equity. So private equity is most often used in reference to its other definition, private equity funds that usually buy majority stakes in companies and then often use debt as part of that purchase. They can oftentimes be called leverage buyout funds, for example. These businesses that they invest in are generally well established and are generating consistent, strong profits. The other thing that's interesting about this is that they are typically not investing in the business, they're buying the business, right? This would be very similar to buying real estate that you hope to use as a rental and generate rental income from. If you buy that apartment building, right, you might use some debt plus some of your equity to buy the building, and then you'll use the rental income to pay off the debt. That's the exact same thing that's happening with a buyout fund in private equity. They buy businesses that are generating really strong profits. Then they use those profits to pay down the debt that they use to buy the business. That's how they make money. Oftentimes, they're not investing more money into the business, and they're not really expecting the business to grow. They don't need it to grow. Just like in your rental, you don't need the property value to go up or the rental income to go up to make money. You just have to wait long enough, and you'll make money off the rental income. Same basic idea with buyout funds. All right, so let's recap real quick. So equity is you own a part of the business and you have a right to the future profits of that business. Private equity refers to equity that is private. It's not freely traded on an exchange, and instead is traded between private parties. So private venture funds, buyout funds, entrepreneurs, etc., one-to-one. And because of that, it can refer to both venture capital and private equity as it refers to leveraged buyout shops, right? And that's where it gets a little bit confusing. But generally, when you read the Wall Street Journal and they say private equity fund or private equity blah, 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 they're usually referring to a leveraged buyout fund, not a venture capital fund. Venture capital funds are a little bit different. They don't buy whole companies, typically. They're usually taking minority stakes in those businesses. And a lot of the times, those businesses are not generating profits. In fact, the vast majority of the time, they are not generating profits. And so the venture fund isn't going to make money off of the current profits of the business. If anything, that company is going to spend all the money that the VC gives them. They're also not buying equity technically from the founder. Now, or the employees or so on and so forth of the company. Just in private equity, when you invest in a company, you're actually buying the whole company, and the money that you invest goes to the entrepreneur, the founder, or the other owners of the business. In venture capital, what happens is the company actually creates new shares. And so everybody, in a way, sells their shares, but it's because they're getting diluted, right? The pie kind of gets bigger. And so in venture capital, the goal is not making money off the profits. The goal is to make money off of the growth. Right? It's to convince investors, like we said at the beginning, that the stock price is going to go up because as the company gets bigger and bigger and bigger over time, it will establish itself as a dominant player, a monopoly in its industry. And as a monopoly, it will generate massive profits. So great examples of this are companies that you know today. So if you look at companies like Google, when they started, they were burning a lot of money. They were spending a lot of money. They were not generating profits. And they didn't generate profits for a long time. But once their business model started to work and they became the monopoly that we all know them as today, where like everybody uses Google for search, right? Now today they generate billions, tens of billions of dollars in profits every year. And the owners of Google, right, the shareholders, have a right to those profits both today and in the future. And so the stock price went up drastically, right, as people understood that someday Google was going to generate a lot of those profits. That is what venture capitalists are going for, right? They're like, hey, I'm going to invest a bunch of money today, help the company grow, hopefully it becomes a huge success, and somebody else buys it from me at a huge price, even if the company's not generating profits, because they can see that eventually in the near term it will. All right, so to recap, you got equity. It's all about being an owner in the business, right? You can ride it to the moon and get tons of profits if it's successful. It also could go to zero and that stock could be worth nothing, right? Your ownership could be worth zero. Then you have public equities and private equities. Public equities freely exchanged on the New York Stock Exchange, NASDAQ, etc., and you can buy and sell on Robinhood. Private equities are more one-to-one, right? They're off of these exchanges, and so by definition, they are less liquid. It's harder to exchange those shares. But private equity can also refer to leveraged buyout funds. And leveraged buyout funds are those big private equity funds that go out and buy companies and generate returns off of the profits of those businesses. Venture capital is also a type of private equity because you can't buy and sell shares in startups on the New York Stock Exchange. So that's why venture capital is a type of private equity, but it's also not the same. It's totally different than like a leveraged buyout. And hopefully that helps you understand the difference between equity, public equities, private equities, buyout funds, venture capital funds, so you can figure out where do you want to invest next. All right, so if that was interesting and you want to learn more about venture capital, check out our next video where I'm going to talk about how to get into venture capital without any experience.